Good afternoon, everybody. Joining us today is Justin Huhn from Uranium Insider. Justin has become a huge thought leader for the uranium sector, whether you're looking at strategy, names to invest in, or just general uranium commentary. In this interview, we get into why Justin likes the uranium thesis so much, the changing sentiment towards nuclear power around the globe, and we talk about strategy when investing in nuclear companies. Guys, this is a great interview, and if you're interested in nuclear power, this is a great overview on why the thesis makes so much sense. So please hit the like button, subscribe, and ring that notification bell, and enjoy the interview. Justin, thanks so much for joining us today.
Happy to be here. Thanks for having me on.
We've sort of seen you appear on YouTube, and you've developed this like huge following. What's your backstory? How did you get into the uranium space?
Well, I first heard about the investing thesis in 2016. It actually was on a podcast. It was on Frank Curzio's Wall Street Unplugged. He was interviewing Jordan Turnbull from Sky Harbor Resources, and it was within a couple of months of the actual bottom for the commodity, $18 a pound for U3O8. That was in 2016, in the later part of 2016. And I found the thesis very intriguing for a couple of reasons. One, prior to that, I had primarily been a momentum trader, kind of a swing trader. And up until that point, that's the entire investing experience that I had had for the most part, with a few elements of dabbling into fundamental investing or mixing fundamentals with technicals. And this was a completely different type of investing thesis. This was 100% fundamentals. The technicals were absolutely broken. This was a sector that was as unloved as the sector could possibly be. It had been a brutal bear market since basically 2011, since the Fukushima disaster. And all elements of the fuel cycle, including uranium itself, had just gone down precipitously for, at that point, let's see, that was 5 years. It continued, the equities bear market continued for a number of years, even though the commodity bottomed. But I was really intrigued by it for a couple of main reasons. One, obviously, the previous bull market in uranium just had unbelievable returns for investors from 2004 to 2007. You saw stocks go from pennies up to $10. Just huge moves over a number of years. So that was obviously tantalizing from an investment standpoint. And the other one was that within a very short period of time of looking into this thesis, inspired by the potential investing returns, I realized that my preconceived notions about nuclear were just completely wrong. They were very tainted by the Fukushima disaster. And it really didn't take long to realize, this actually is clean energy. This is a very important industry in the world. It produces, close to 10% of the world's electricity, almost 20% in the United States. And it's clean and it's safe, and it's the safest form of electricity that's ever been conceived. And so that really intrigued me. And I love when my preconceived notions get turned on their head. That really excites me. So those two things combined just struck a chord with me, and I stuck with it. I kept researching over a period of a couple of years. I found myself within a small community on Twitter of maybe a couple dozen people that were pretty knowledgeable about the uranium space and the nuclear space. Started a Twitter account, Uranium Insider, not really knowing what I would do with it, and it just really kind of snowballed and developed naturally, to the point where I had a reasonably sized audience, and I had people literally coming to me on Twitter and through email asking me to start a newsletter service. They wanted to know what I was buying and why. So it really was an organic process. So that was August of 2019 when I started Uranium Insider Pro, which is the paid newsletter. Built that up into a pretty sizable community. Twitter continues to grow, doing the podcast on YouTube now, and it's all I do now. It's 100% uranium. I have a small, very dedicated and intelligent team behind me at Uranium Insider. And so it's a very exciting space to be invested in that we feel really good about because of the environmental implications, and the future of this sector looks extremely bright.
So I find that interesting in the sense that you are getting a firsthand look at the data of retail investor interest in uranium. Um, what can you tell us in terms of when it started to take off and where are we today? Did it plateau, say, in fall of 2021 or maybe, I don't know, December of 2021? Or is it consistently growing over the last, since Sprott kind of came into the scene with their physical trust?
Sure. Yeah. Well, retail sentiment is a really interesting indicator. Obviously, retail sentiment, generally speaking, is euphoric at the highs and despondent at the lows, which is pretty much opposite of how you want to invest in a sector like this. When everybody hates it is the time to be buying. When everybody loves it is the time to be selling, or at least trimming. Um, so, with that said, the equities bull market, in my opinion, really kicked off in December of 2020. We had a recovery since the March 2020 lows, and as did everything. That was the buy everything moment across all asset classes. But uranium had peaked just a couple months after March 2020, when we saw Cameco in the market buying because they had to shut down Cigar Lake. And then it just kind of plateaued, the price of uranium I'm talking about here, into August, September of 2020. Kind of flatlined for a couple of months. The excitement about the recovery after March 2020, when they shut down Cigar and Kazatomprom stopped their wellfield development for 6 months, that sentiment started to kind of wash out. And out of nowhere, first week of December 2020, the equities just took off on huge volume. And in hindsight, what we understand from that moment were a couple of things. One was there were a number of high net worth institutional investors, and primarily a newsletter that goes by the Bear Traps Report by Larry McDonald, that goes out to a very large audience, 600 plus institutional investors. And that newsletter came out basically saying that this is a contrarian's wet dream. We're buying Cameco, we're buying URNM, which is the uranium ETF, pure play uranium ETF. And this sector has a very, very bright future. It's an energy play. It's a seasonality play. Typically in December is when you start to see strong seasonality for uranium. Not every year, but most years. And that really set things alight. And so we had multiple months, probably about a 6-month run of high volume, higher highs, higher lows, good trend. That pulled back into last summer. Then Sprott came on the scene, took over Uranium Participation Corporation, which is a physical uranium trust, a fund that he turned into a trust. And they developed an ATM, an at the market financing vehicle, where they can actually issue shares into the open market when they're trading at a premium to net asset value. They came on the scene. Their ATM went live in August, third week of August of last year, and they bought 10 million pounds of uranium in the first 4 or 5 weeks. And the price went from the low 30s to the 50s, just like that. 60% move in about 2 months, and the equities went absolutely bonkers. We then pulled back since December, January started to pull back. Sentiment started to return. So really, long story short, we're at this unique inflection point where there's so many fundamental developments that I could talk for hours about, and we obviously don't have that much time. But basically, let's just say that the fundamentals are extremely strong for uranium and for nuclear. Sprott is still there. They've been actually raising cash for the last week and a half or so, after being at a discount to NAV for about 6 weeks. And but we have this risk-off moment in the markets, and we've got this unique situation with high inflation and the Fed stuck in this weird place, between a rock and a hard place, trying to fight inflation at the same time, not completely crater the markets in an election year. So it's a very unique time where sentiment is still kind of mixed. It's very negative across just general market sentiment, but it's very positive with nuclear. And I think that the energy is sort of pent up here. I think it's possible we see another big move coming relatively soon here.
So you say that there's a number of fundamental issues that you could go into that are just massive bull cases for this. So out of all those options, what's your number one bull case for why this will continue?
I think that, gosh, that's a hard question, actually.
I know it is.
And I'm always trying to poke holes in this thesis, and it's very difficult to do because it's just so strong at the moment. Number one, I would probably say that has me most excited right now is this strongly shifting sentiment for nuclear, because the original investment case for this was just like a static supply and demand calculation where we saw multiple years of less uranium produced than was consumed. And this year is actually the extreme of the past few years. We're going to see a primary production of about 135 million pounds of uranium and close to 180 million pounds of uranium consumed worldwide. That's a huge, huge supply shortfall. And that really was the primary thesis, going back 2017, 2018 was, well, we've got this supply shortfall and the price needs to be here in order to bring new mines online, let alone bring on the mines that are shut in as, care and maintenance back to get to some semblance of a balanced market. And looking out towards the end of the decade, it's like, yeah, it's obvious we need to be at that marginal cost of production to bring some of these projects that need, at this point with inflation and everything, that need $80, $90 a pound uranium in order to come online to balance the market out into the end of the decade. So that was kind of the primary thesis. It's a growth sector. It's growing 1% to 3% a year. The supply is in a shortfall. There's still some above ground mobile inventory that will buffer that supply shortfall for the meantime. That was a couple of years ago. We worked through most of that. But never in my wildest dreams would I have thought that we would see the environmental left start to embrace nuclear. And that's what's happening right now. We're seeing Silicon Valley techies embrace nuclear, excited about the future of nuclear. There's a whole new movement about advanced nuclear and small modular reactors. These are new reactors that are have fail-safe protocols where they're basically meltdown proof. They can be plugged into smaller grids. They can be built in factories and assembled on site. And it is a very, very exciting space. You're seeing the Elon Musks of the world, the Chamath Palihapitiya's of the world, just this huge upswell of positive sentiment for nuclear. And that was something that I never expected even 3-4 years ago. And that's really kind of this tide that's supporting, you can geek out on the fundamental, supply and demand fundamentals all you want, but underneath that, sentiment matters, and sentiment is growing for this sector, not only just because of the clean energy aspect and concerns about the climate, but also now we're seeing just big energy crises around the world in multiple different jurisdictions across Europe. It's getting really bad right now. Japan, the government in Japan is telling the whole family to huddle in one room and watch one TV with the air conditioning off. Now we're seeing warnings coming from CNBC, coming from the Wall Street Journal, coming from the Biden administration, saying we're looking at energy shortages in the United States coming this summer, warning of rolling blackouts. And so it really ticks a lot of boxes. It ticks the energy crisis box. It ticks the clean energy box. It ticks the technology box. So that's probably it. I think that's the number one bullish factor for me right now is this upswell and positive sentiment and support for nuclear. California is thinking of keeping Diablo Canyon online. I mean, if that doesn't tell you how much this has swung in terms of sentiment, I don't know what can.
Yeah, I mean, obviously there's a number of factors at play that weren't necessarily predictable, such as the tensions in Europe that just caused energy prices to go bonkers from already high levels. But I think for me, the most interesting aspect of the entire uranium story is actually the most boring, which is the supply demand. How is it that there has been a supply shortfall for so many years, and yet the price of uranium has not reacted to it? Like that's the part that I struggle with. When was the oversupply situation? And like, is there a sense necessarily of how much is just remaining in inventories? Because after so many years, one would think that it's got to be near depleted.
Sure. Well, I mean, first of all, the price has responded. We bottomed out at $18 a pound. We're just above $50 a pound here. So it has come back quite a bit. We're still well below the price that's needed in order to have a balanced market out into the future. But it is a really good question. So we really didn't see a supply shortfall type of market until 2018. That was when Cameco shut down McArthur River and started buying on the open market. But really what led to the long-term bear market and why it took so long for price really to respond was we had a huge oversupply. So what happened was in the years leading up to the peak of the price of uranium in 2007 was a fast ramping up of development projects. Now, really, there was only one new mine that came online during that period of time. That was Paladin's Langer Heinrich that started producing pretty close to the top of that market. That market corrected, but then it started to recover back up into the 60s. I think it even hit into the $70 a pound range before Fukushima. So what you had was close to a decade of slow and then faster development of new projects and ramping up of production. You had the Kazakhs massively ramping production, which is they're the largest producer in the world. They produce 40% of the world's uranium. And they were 100% state owned at the time and basically controlled by Russia. And so they were producing uranium like crazy, just drastically increasing production year over year over year. They kept pumping it in the market. Meanwhile, the price of uranium is falling because Japan shut off all 54 of their reactors, which was what, 12, 13% of global demand. They shut that off within 12 months of Fukushima. And they had uranium inventories to sell into the market. So you had Kazakhstan producing, you had Paladin producing, this mine they just brought online. And then you had the Japanese demand come offline. So all of that happened over the course of a couple of years. In Germany announced they would shut down all their reactors by 2022. That's still in play, by the way. They've got 3 reactors left that they plan to shut down by the end of the year. And they just shut down 3 more in December in their unending brilliance. So now we're at the situation where the previous decade, let's just say you had 250 to 300 million pounds of oversupply in the previous decade. Now we can assume China took probably half of that. They've bolstered an inventory. China has a big inventory, 400 million pounds of uranium, right? Uranium equivalent. And so let's just call it 130 to 150 million pounds of oversupply that didn't go to China, that was available in the open market. It took years to work through that. And we believe, based on our calculations, based on the supply shortfall that we've had since 2018, the amount of pounds that Cameco has purchased, the amount of pounds that the Sprott Physical Uranium Trust has purchased, which is 35 million pounds since last August. We're close to an inflection point, and we're seeing evidence of that now because it takes a very, very small amount of purchasing in the spot market to see a significant price movement. And so we have this very ripe scenario where all it will take is either demand from traders or utilities in the spot market. And generally speaking, the utilities are not that active in the spot market because they don't want to move the price. They are incentivized for lower prices. Of course, they have contract deliveries ongoing from previous years, signed contracts that are at least partially referenced to the market price at the time of delivery. So to the extent that they move the price up by dabbling in the spot market, that affects the bottom line of either their own utility or another utility. So they're kind of on the same page. We're staying away from the spot market. And they have inventories that can allow that to happen. So, financial flows coming into the market could very easily cause a very large movement in the price in relatively short order.
Do you have any general, or have you come out with any general sort of price target or estimates on where you think the price could be heading in the, say next 12 to 24 months?
Not really. I mean, the previous price that peaked out in the previous bull market was around $134 a pound. Now that was well above the price that was necessary for a functioning nuclear market, let's say. You did have utilities pay upwards of $100 a pound. The fuel buyers that actually engaged in those contracts never lived it down. And so the price spike beyond that was entirely driven by financial players. You had hedge funds buying uranium back in the day. And now you have less hedge funds buying uranium because they can literally just buy trust units in the Sprott Physical Uranium Trust and have exposure to the commodity without having to physically hold uranium on their books. And it's a liquid vehicle they can trade in and out of as they see fit. So, I mean, you can apply an inflation metric to 134 and come out, close to $200 a pound. But really what we do is we say we calculate the necessary price that's needed to balance the market out at the end of the decade. And that means all of the marginal projects, the development projects that are in PEA, PFS, DFS stages now, what do those need in terms of pricing in order to actually get those projects into development? So you'll have something at the higher end of the cost curve, which is still a great project, which would be Bannerman's Etango project in Namibia. It's lower grade uranium. But it's hundreds of millions of pounds of uranium. It's a big project. They needed $65 to $70 a pound 2-3 years ago. Okay, so we're talking 85, 90, if not $100 a pound for projects like Etango to come online. There are other projects that are in that similar cost curve. So we basically say we need the price to go, let's say $85 to $100 a pound in order for us to get to a balanced market out to the end of the decade. And you're like, okay, end of the decade, that's a long time away. This sector moves unbelievably slow. It takes years and years and years and millions, if not billions of dollars to develop uranium projects. For obvious reasons, it's one of the most difficult elements to mine, not because it's lacking in abundance or has high grade areas in the world, but just because of the regulatory conditions of mining uranium. For obvious reasons, it's a radioactive isotope, and so basically we need those prices. Anything above that, as Mike Alkin from Station Co says, is gravy. And judging by what I just said about the thinness in the market and the thinness in the spot market and the fact that we have this spot vehicle here now, it's basically just a matter of time before there's fund flows into the sector and into that vehicle sufficient to push the price to levels that are beyond what is necessary for a functioning nuclear market. So it's, the sky's the limit. It really is up to the financial players, essentially. I mean, to put it simply.
So do you have a general strategy that you use to play the space? Are you looking at the ETFs, the producers? Do you play with any of the exploration companies? What's your general way of gaining exposure to the space?
So we have what we call a focus list of companies, of positions. We actually have 11 positions now. We typically keep it at 10. We have a couple of companies that we own in half size positions, and then we have an options position. So 10 companies and plus this options trade that we've engaged in. And we have a method for seeking out investments that we feel will outperform the ETFs. We did this last year. URNM was one of, if not the best performing ETF in the entire investing world last year. It returned, I think it was 78% in 2021. And we did 122% last year. And we focus on a number of factors. One is obviously the team. We look at management more than I think anything else. So what has management done in the past? How do they treat shareholders during the bear market? How are they treating them now? We look closely at the share structure of the stock. So we want to see how many outstanding options and warrants there are. What is the free float? How dilutive has the company been in the past, et cetera. We obviously look at jurisdiction. We want to invest in jurisdictions where there has historically been uranium production and there currently is support of uranium production, at least for the primary asset for the company. And then we look at the asset itself. So the asset itself or assets obviously matter, and a combination of all of those things. Plus there's kind of this, I don't know how the wow factor that you can't really calculate per se, but a company has to have the right balance of conservatism. Like you don't want an arm waving company that's out there just spending millions and millions and millions of dollars on marketing, while at the same time just trying to pump their stock constantly. But you also don't want a company that is dead quiet and just too conservative. And a balance between those two things is very important. We really, really like companies that have individual company catalysts that will propel the company upward even in a market that stays flat. And we don't expect the market to stay flat in terms of the commodity. But if a company has an individual company catalyst during a bull market for the commodity, those are the stories that we really like.
Where can our audience go to get more commentary?
You can find us at uraniuminsider.com. I have a pretty active Twitter account at Uranium Insider, where people reach me relatively frequently. And I also do an almost daily podcast on YouTube called the Uranium Market Minute, where I cover just kind of the flows in the space, spot price. I do a brief review of the charts, and then I just pick a topic. Oftentimes I'll have questions come to me from the YouTube comments and through email, et cetera, that I try to address on the podcast. So through any of those means, we can be contacted. And if your audience is interested, they can send us an email or contact us through the website, and we can send them a free sample of a previous month's newsletter, get an idea about the type of content that we put out.
Awesome. Thanks so much for hopping on here, Justin, and doing this. And hopefully in the future, as we see the market continue to develop, you'll come back on here and continue to update us on the space.
It's my pleasure. Yeah, happy to come back anytime. Thanks for having me.
Thanks so much for watching, everybody, and please let us know what you think in the comments section. How are you playing the sector? And ultimately, where do you think that the price of uranium is going to go? All right. Thank you, everybody.